This podcast is for informational purposes only and is not to be considered personal, legal, or investment advice or a recommendation to buy or sell securities or any other product. It is based on opinions, current events, press releases, and interviews, but is not infallible. It may contain errors, and Living Your Greatness offers no inferred or explicit warranty as to the accuracy of the information presented. If personal...
Welcome back, everyone, to Living Your Greatness. This is your host, Ben Mumme, and today we have a new guest to the show, and his name is Lobo Tiggre. For those of you who don't know Lobo, he is the founder and CEO of the principal analyst and editor of Lewis James LLC. Lobo researched and recommended speculative opportunities in Casey Research publications from 2004 to 2018, writing under the name Lewis James for privacy reasons. While at Casey Research, he learned about the newsletter business from Casey co-founder David Galland and the resource speculation from the legendary speculator Doug Casey himself. During Lobo's time with Doug Casey, he also learned from many other industry leaders, including Sprott-Global's Rick Rule, former newsletter writer Bob Bishop, fellow newsletter writer and geologist Brent Cook. During Lobo's time with Doug Casey, he also learned from many other industry leaders, including Sprott-Global's Rick Rule, former newsletter writer Bob Bishop, fellow newsletter writer and geologist Brent Cook, exploration geologist, and multiple mine finder Ron Parratt. So Lobo, welcome to the show today. It is great to have you on.
Thank you so much. I'm really excited to be able to talk about a little bit broader universe of things that we're all involved in.
Absolutely, for sure. So Lobo, let's get started. Can you share with our listeners a little bit about your background? Where are you from? Can you also tell us more about your formative years and how you ended up in this profession? And lastly, how did you receive the opportunity to work closely with Doug Casey himself?
In some ways, this will be encouraging and maybe discouraging because on the one hand, I think if I can do it, anybody can do it. I had no particular advantages here. On the other hand, it was a very unusual path. I don't think it could be replicated. So let's go there. In the first place, I was basically an Army brat, if you know what that means. My father was in the Navy. We moved around a lot. Then my parents got divorced, and then it was bouncing back and forth between the households. I counted them up, and by the time I graduated from college, I had been to 23 different schools. So, and I don't know how many countries. So a lot of bouncing around, not always with happy outcomes. I was an obnoxious teenager. I was in a lot of trouble. But I was independent thinking, and I became sort of the black sheep of the family, the atheist, anarchist, rabble-rouser out there. And turns out that was basically Doug Casey's story. So when I bumped into Doug Casey, long story I won't get into, but spoke to the guy, interviewed him, much as you're doing now, and spoke to him for an hour, and all of his answers to my questions were almost what I would have said. So we formed a friendship, and then there came a time when he and his partner, David Galland, who founded Casey Research, turned Doug's newsletter into Casey Research in 2004, were looking for a writer/editor to help them out with that, and they knew that I was a writer. So there were people with lots more geological knowledge than I had, and MBAs in finance and other types that they thought about. But they knew me as a person who was intelligent, active, excited, and could write, and very motivated. And they really brought me on as a person. So the resumes and the normal job application route wouldn't have done me any good. And this is where I'm going with the good news and bad news. So the bad news, it wasn't what I knew, it was who I knew. And if you didn't know Doug or David at that time, you wouldn't have been able to get hired. On the other hand, the encouraging part is that, Doug and David took all that, MBA and PhDs in geology and set all that stuff aside. And they hired me as a human being, right? They hired me because of who I am, not who I knew, right? Or I like to think so anyway. And then I just, I loved it. I always as a kid loved geology, never studied it, but I had rock collections everywhere I went. Right. And so here I got a chance to learn geology and get paid for it. And I love to travel. I got to travel around with world-class geologists kicking rocks and got paid for that. I like to write, and I was able to write about this interesting stuff and get paid for it. Everything just worked out. So good news, bad news there. Tortuous path, very strange set of circumstance that resulted in Doug and David offering me this strange and wonderful job. There's a Zen saying that when the student is ready, the master will appear. And maybe the most important takeaway of all of this is that most of the writing I had been doing, I'd written my great libertarian novel, and I had written lots of short fiction. And at the time I was writing grant proposals for free market oriented think tanks when Doug and David offered me the job. So I was very busy saving the world for freedom and free enterprise and all that good stuff. And just a couple months before this happened, I had been thinking, I write about capitalism all the time and how great it is, but I'm not a capitalist. I don't have any money. Maybe I should start thinking about money more seriously. Maybe I should actually try to make some. It'd be a lot more fun to write checks than to ask people for checks. And so I just kind of came to this epiphany and thought, I need to get serious about money. I need to start learning about money. I've never invested in anything. I don't know anything about money. And it was literally 3 months later that Doug and David offered me this job. Had they offered it to me before I had that epiphany, I probably would have said no. I was happy saving the world, maybe not monetarily compensated, but soul compensated. I felt good about what I was doing. I probably would have said no. Newsletter writers, nah. But having made that decision, the door opened in my mind and they offered me the job and I said yes, and completely changed everything. I'm still the same old Lobo. I'm still the same old rabble rouser. I still care about the same values and causes. But it is a lot more fun to write the check than to ask for the check. I think that's an important lesson for anybody watching this to take away. If you're not interested in money, if you don't care about money, why would money come into your life? Open that door.
Awesome. Thanks for sharing that story, Lobo. So Lobo, I've heard you interviewed on a number of talk shows and podcasts, and what's impressed me the most with your interviews is your knowledge on both the macro and the micro picture. What macro indicators do you pay attention to in addition to the technicals when you analyze the markets?
Well, I'm not a technical analyst. I don't pay a lot of attention to the technicals. I'll come back to the macro, but just to quickly put the record straight there, I look at those charts and the support levels and the channels, and it's interesting, but it always strikes me as somewhat driving by looking in the rearview mirror. And very, very few people, I think, have a good record of making solid predictions. Like if I'm going to use technical analysis, I want to know that in X percentage of this cup and handle pattern or flag and pennant pattern, it means that things going up. I want to know that it's going up or down. I want to know. And if I don't know that, it's just like, oh, look at this interesting pattern. That's not useful to me. So I watch it, but I'm not heavily into technical analysis. On the macro side, I'm really quite a generalist. This I take after from Doug Casey. We come at things from an almost philosophical point of view. We have a worldview. Speaking just for myself, I have a sense of economics. And sometimes it takes a long time for the unintended consequences of bad economic policy to become manifest in the economy. This makes it very confusing. People do something, government does something that's just boneheaded dumb, and yet they seem to get away with it. And it seems like, oh, well, so maybe you can print all the money in the world that you want and nothing bad will happen. Well, no, that's not true. You can get away with stupid things for a long time. Sorry, that's a technical description. But this is coming to answer your point. And that is, if you want macro trends and data-driven analysis and a very rigorous approach to macro, I would actually recommend Lynn Alden, who I recently interviewed, as a person who really comes at this from a numbers-oriented perspective. And she has that data at her mental fingertips in a phenomenal way that I greatly respect and I think is quite useful. I'm not sure I actually need all that, though. I know that eventually the piper must be paid. I know that government profligacy has consequences. And even if I did have a model, and this is the first thing I asked Lynn, like these models, how often do you stick your head outside the window to see if the weather matches your weather model? Because these models, they can convince people that they know what's going to happen when they really don't. And that scares me. So what I'm saying is I'm a generalist. I look at the macro picture on not a purely theoretical basis. I look at what's actually going on, but I look at it within the framework of my understanding and how I think the world works and how it doesn't. And when I see things that completely contradict how I think the world works, then I'm willing to invest accordingly because I think there will be consequences for that. I'm happy to get the direction right, even if the timing is highly in question. I'm deeply suspicious of models that give us detailed predictions about when and what is going to happen. I'm much more comfortable with models that have a more macro outcome. So for example, Lynn's outlook and her guidance is multi-year. She doesn't say, oh yeah, next week there's going to be a stock market crash, or in 6 months the dollar's going up, or whatever. She says over the coming years, this is what's most likely to happen. I'm comfortable with that. And that's pretty close to my way of doing things. But I'm more suspicious of modeling. Like if I had a general economic model and put in the dollar and the euro and I put in the inflation and the latest CPI number, I think that gives people a false sense of security. You have this great model. It's science, it's numbers, it's math, right? Ooh, and that gives people the sense that, oh, I know what's going on, or I have this more solid mathematical understanding, and I just think that's very suspicious. I think that's very dangerous. So that may sound like a cop out. This has long been the criticism of Austrian economists. They're not mathematical. They're more like historians. But I actually think that is a sensible way to approach something that's so inherently chaotic as a global and national economy.
Thanks for sharing those insights, Lobo. So this actually brings me to my next question. The rate of monetary inflation has gone crazy. Tons of money has been printed and prices are going up. Is price inflation transitory, as the Federal Reserve suggests, or are prices going to continue to go up? What do you think, Lobo? And how will inflation eventually affect the gold and silver prices?
Okay, well, you get kudos just for framing the question in terms of monetary and price inflation. There's so many people who just say, oh, inflation is this, and they think CPI measures that. Or, sorry, but there's some people who say inflation is money printing. And yeah, that's the original meaning of the term. But if people aren't seeing prices going up, they don't care if inflation is money printing. You need to look at the bigger picture and look at these different kinds of inflation and how they relate, and the rubber band effects between the two, which is relating to what I was saying earlier, why people get so confused. People want to discount the money printing as not important because they don't see the next day that the price of bacon's gone up. They are starting to see the price of bacon going up now, which is why we're talking about this, why it's so exciting. So my answer is kind of a bit of a yes and no here. And I'm not being mealy-mouthed, I'm being specific in that, of course, base effects are real. Of course, if you have a marked decrease in inflation a year ago, or at least inflation as measured by CPI, and this year's CPI is much higher because it's compared to that low base, of course that can't be sustained. That's mathematically something that I would agree with, and it is reasonable. But that doesn't mean that prices aren't higher. That still matters. And if the base effects can be subtracted and you're still left with significant inflation, that means something. And okay, if you discount the increase, the yearly increase, because of the base effects from a year ago, but the monthly increase is still up, which it was in the most recent CPI numbers. On a lot of things, the monthly increase was still up, or at least flat. The overall monthly change was flat, but therefore still high, right? So your month-to-month change is still high inflation. That tells you it's not just a mathematical abstract. It's not just the base effects, that prices actually are higher. So I think that's important. Now, will they stay higher? Well, so as the base effects come off, they go into reverse and they actually become a headwind, at least for CPI as measured by the government, right? So I think it's reasonable to predict that as the base effects roll off and they actually turn into a negative for CPI, that you're going to see numbers and inflation reported reduced. And that matters because traders, the people, traders, not traders, though I like to joke that many people in the metals community see the two as the same. But traders in New York and London, they go off these CPI numbers. Their models, their computers, their algorithms use these numbers. So if CPI is going down and real rates, therefore, are less negative, then that's bearish for gold and silver. So we could see significant headwinds from this in the near term. But the reality is, you're looking at the world, not CPI, looking at the world, you've got all these supply disruptions, and okay, you can fix them, but you still have the supply disruption. You have changing supply chains, you have the tensions between China and the US, you have not just the government's pushing for changes in supply chains, but the companies realizing, oh, we need more flexibility in our supply chains. all these disruptions matter. They're not just inflation caused by consumer expectations, right? Or consumer confidence. They're actually restrictions on your ability to get the stuff that you make widgets and computers and cars out of, and that pushes prices up. And I don't think that goes away. That certainly doesn't go away based on a base effect. I think that's enduring. And it remains to be seen just what the long-term consequences of all these shutdowns will be. I mean, never mind the medical situation. I'm not a doctor. I'm not going to comment on that. But the shutdowns have consequences. You can't just turn off the engine of the world like a light switch and flip it on again and think there'll be no long-term harm from doing that. And we don't know yet. We have this square root so-called recovery, right? We have all that harm. We have everything's coming screaming back. But what will be the level after things level out? You know, how much lasting harm will there be? Nobody knows that. None of these models can predict that, because the last time something even remotely similar happened was 100 years ago, and there was no model back then. We don't have the data back then. So what I'm saying is, I think for mathematical, econometric reasons, it's reasonable to expect inflation, official inflation headwinds this fall, going into this fall. But the reality is that the world has become a more difficult and expensive place to operate. I think that means that real price inflation will be higher, and it will be enduringly higher. And that fits with the monetary inflation you started your question with. You're printing all these dollars or whatever, euros and yuans and yens, and you're giving them to people. Last time in the great financial crisis, so-called, you know, they printed all this money and most of it went to the banks where it stayed. This time they're mailing people checks, big checks, and you're seeing it. You're seeing the months after the stimulus checks go out, you're seeing the price inflation, you're seeing the spending going up direct, and then there's no stimulus check and there's less, and then there's another stimulus check and there's more. So you can actually see the money printing showing up in the price inflation this time, which is really dramatic. And I think it's a big problem for the MMT crowd and the folks who want to claim that money printing doesn't matter. So there you go. Near term headwinds, longer term, I'm extremely confident that we will see very high levels of inflation.
Okay, great. Thanks for answering that question, Lobo. So this brings me to my next question. There appears to be a lot of talk about Basel III. Can you explain how the bullion banks would be affected and how disruptive this will be to the precious metals paper markets? How will the physical metal prices be affected? Will they go up or will they remain the same?
The answer to most of that is no. No, I can't explain it. And that's partly because in the first place, I'm not a central bank expert economist. You know, I don't know the ins and outs of central banks any more than anybody else does. And I'm not even sure the central banks themselves really know what they're doing. On top of that, you know, what is a bullion bank and how does their business work? We have lots of theories on the outside, but do we know? No, we have assumptions and theories. We don't know how this is going to work out. The one clear piece about this to me is that the LBMA and the World Gold Council sent that famous letter to the regulators asking for an exemption for the futures markets on the new reserve requirements that are supposed to go into effect at the end of this month. That is a fact. You know, it is a fact that they said this will affect our business negatively. It will increase our costs, and we're asking for an exemption. Now that's interesting to me. I like being able to deal with facts and not just theories from some guy on Twitter. And so far there is no exemption. That is interesting. It might be that you know, like it has been before, Basel provisions get delayed or postponed. It keeps happening. So the number one thing I always tell people when they ask about Basel is, remember, these things keep getting postponed. It's a mistake to think that you know that the world is going to blow up or happy days are going to come on July 1st. It may or may not happen. It just, the whole thing could get completely postponed again. All right, let's say it's not postponed. How will it affect the inner workings of the bullion banks and the central banks? That's above my pay grade. I can't tell you that. What I can tell you is that the futures markets are telling us this will increase their costs, make it more difficult for them to run their businesses as they have. I'm not going to shed a tear if that happens. I wouldn't mind to see the paper markets become less efficient. It might increase the incentive to bring more physically based price discovery to the market. And I'm not promising this. I'm not one of these guys who say, Basel III is going to end the COMEX and woohoo, happy days after that. I don't know that. Nobody knows that. What I am saying is that they're saying it's going to increase their costs to make their business more difficult. I would like to see that result in more physically derived price discovery. And I would hope that the market would see increased cost of paper proxies as an incentive to develop these alternatives. So I'm hopeful that this could actually lead to good things. It could lead to bad things. It could, it could just result in greater opacity in the market. Suppose those paper gold and silver prices that we love to hate so much, suppose they just go away. Where are you going to get your price of gold today, this minute, this live gold price? Where are you going to get it? You're going to run down to your coin shop and say, what are you paying right now? How are you going to amalgamate data from what every mom and pop trader out there is willing to accept? The reason why we use these horrible, easily manipulated, misrepresenting paper prices is because they're live, they're online, the data is there. It's very easy and convenient to say what at least some buyers and sellers in this space are willing to exchange metals futures contracts for. That makes it very convenient. So if we blow that up and we don't have a substitute in place, it could make things kind of difficult for gold bugs. What is your gold worth? You don't know. Well, what's it worth to me? Well, to me, it's worth $10,000. Well, if to him it's only worth one, we don't have a deal. Where do we go? I'm just saying, be careful what you wish for here. Things could get interesting in the Chinese sense of the word, but my bottom line here is that, like many of us in this space, I would like to see a price discovery that's more based on actual transactions of the metals themselves. And if the derivatives and futures markets become less efficient, I'm hopeful that that would help in that regard.
Okay, great. So is there a risk that the broader equity markets could correct or collapse soon? If we do have a market adjustment or crash in the coming year, how would this affect the price of the gold and silver metals and the corresponding miners? Will they drop as much as they did last March?
Yes. This is one of those things where it's a complete unknowable. It seems like on Wall Street just doesn't want to die. It doesn't matter how many times you shoot that bull, he just keeps on charging. Honestly, with all that easy money flooding out of Washington, it's understandable. Of course he keeps charging. No matter how much he bleeds, they keep injecting more money into him. So he could keep going for years. It could be that the powers that be kick the can down the road for a long time. I cannot tell you that I know that the market's about to fall over. That bull's bled too much and he's going to keel over. What I can say, though, is that, at least my perception is that pretty much everybody, even the Wall Street cheerleaders, they all know that bull is very long in the tooth. It's, I think, a mistake to think of this new bull since last March. Like, technically, because of the magnitude of the correction and rebound, you can say, oh, it's a new bull market. Started just last year. It was brand new. It's not long in the tooth. This is a new bull market. But really, what we have is a long, better than a decade bull market with a brief interruption based on this really external effect from the COVID shutdowns. I think of it that way. And I think most people on Wall Street think of it that way. And I think most people, again, in their heart of the hearts, if you ever shot them with the truth ray and they were to accidentally say the truth on CNBC or wherever they're talking, I think most of them would say, yeah, these stocks are overvalued. This market is at nosebleed heights. Everybody knows it. And that means that you don't actually have to have a cause. You don't need to have, another wave of new mutant COVID to scare everybody. You don't have to have anything. It could just be that, some highly levered trader wakes up one morning and says, you know what, I'm out. I need to get my money back off the table. And that just butterfly effect, triggers somebody else's stop loss, which triggers a bunch more, which triggers this waterfall event of people who all know, inside their heart of hearts, this stuff's just overpriced. And everybody, oh no, look, people are starting to sell. Well, I'm gonna sell before those other guys sell it. And you could have a major waterfall event with absolutely no visible cause whatsoever. And of course, if there was some visible shock, if the Fed were to suddenly do an about face and say, yeah, we really need to start thinking about tightening, that could also do it. So I see Wall Street as very shaky, as very risky. I understand the FOMO. I understand how hard it is to stay out of these markets and just see these stocks keep going. Oh, look at all that money I didn't make. But those people are skating on thin ice. And the moment that breaks can be too late. And, some people might be able to scramble to safety, but a lot of people won't. I think when that ice breaks, a lot of people are going to get hurt. And I'm not going to be among them. To answer the question for gold stocks, yes, if there's a general market meltdown, whether it happens now or next year, whenever it happens, there's always another one. When it happens, everything gets whacked. Everything gets whacked, even gold itself. We saw this last year. We saw this in 2008. Even 1987. I wasn't there, but I've seen the data, right? Anytime there's a major market crash, everything gets whacked, including gold and silver. Not because gold is not doing its job, but because gold is doing its job. In those moments of extreme acute liquidity crisis, you sell anything you can get a bid on, and that includes gold. It's a savings vehicle that rescues you when nothing else will do. And we've seen that in the markets. So yes, everything gets whacked. And as we've seen, though, gold comes screeching back. Those are not U-shaped bottoms. When that happens, it's a V-shaped bottom. As soon as the liquidity crunch passes, comes screaming back. And the stocks, however, they take a while. The very best, the obvious winners, the ones that people missed, some great discovery or some highly profitable gold or silver producer, when everything goes on sale, the metals go on sale, the stocks go on sale. And those ones that people said, man, I wished I bought that one when it was half the price. Well, now it is half the price and the metals are recovering. So people pile into those. So even, the better stocks can also have a V-shaped bottom. The rest, they'll kind of take a while. Higher metals prices will eventually drag all of the stocks on average upwards. So the short version of the long answer is, should we be so lucky as to see a broader market crash and not be skating on that thin ice, then I think it will be a spectacular buying opportunity, both to lock some long-term savings away in the metals and to speculate on the better stocks. I see these events as being like a time machine. You know what the successful stocks are, and you get a chance to buy them like at prices before they were successful. That's a gift.
So Lobo, in your newsletter, you were talking about the relationship between changes in the US dollar index and the price of gold. Did I understand correctly that there appears to be a closer relationship between gold and the US dollar rather than the 10-year bond rate? Could you please explain for our listeners?
Sure. Well, the context here is that ever since the US dollar was formally and finally and completely severed from gold in 1971 by Richard Nixon, there have been a number of variables that impact the so-called price of gold. I think of it as the gold-dollar exchange rate since then. But gold price, right? It gets moved sometimes by wars and geopolitical risk. It gets moved sometimes by direct inflation, by dollar movements on the foreign exchange markets. But the single most explanatory variable for the price of gold since 71 has been real interest rates. It's not the only one, it's not absolute, but it's the strongest, the most highly correlated, the most explanatory variable for the price of gold since then has been real interest rates. And so, by the way, even in times like in the 70s, you can have high interest rates, but even higher inflation. So the real rate is negative, and therefore we saw higher gold prices. So that's the context. Now, real rates are not easy to calculate on a moment-to-moment basis. You get CPI once a month. And the way you normally calculate your real rate is to take whatever interest rate you're most interested in, the Fed funds rate or the benchmark 10-year, or if you're in the real estate business, you might look at the 30-year or something like that, and then subtract CPI. So the nominal rates, they're moving every day, all day long. But CPI only changes once a month. So you have this sort of lag in what is the real rate today. Well, the proxy is to take the nominal rate and subtract CPI from it and say, oh, that's close to the real rate today. But the reality is you don't know. CPI has actually changed since it was last published, but you only have that old number. So why this matters is that in between CPI numbers, you tend to look at the nominal rate and kind of use it as a substitute, as an indicator for what real rates are doing. And that's why over the years, you look at what the interest rates are doing, and the movements correspond very highly with gold price fluctuations. So what you're bringing up and what's happening now that's really interesting is that people are starting to get the picture that CPI, one, it lags, things are highly fluid, and two, maybe CPI underrepresents real inflation. And so if your model is that real rates are going to make me buy, if you're one of these traders in New York or London, and your model is going to say, okay, real rates more negative, I'm buying gold. Real rates more positive, I'm selling gold. Well, what happens if you no longer trust that CPI number, which is out of date, to adjust your real rate? You need to look somewhere else. I can't prove this. I can't say I know this. I haven't talked to all these traders and asked them, how have you adjusted your model? And these are proprietary models. They wouldn't tell me if I did ask them. So what I'm saying is that we've started to see that the benchmark 10-year rate, which is the one that tends to correlate most closely. I'm sort of waving my hands here because you just look at these charts. They're like a Rorschach test, right? It's a butterfly, it's a cloud. They're opposite images. And that's what these charts do horizontally, right? The 10-year goes up, the gold goes down. You just look at it on a day-to-day basis. These lines vary in an almost mirror image. That's been breaking down more recently. We have seen days where the 10 rate and gold will go up together, but the dollar went down. And that's what you're keying in on. What I'm thinking is happening here is that traders are increasingly suspicious of adjusting automatically for CPI, and they're looking for alternatives. And ultimately, the dollar is what gold is priced in. So if you don't trust CPI and you're looking for something else to adjust your model, well, maybe you start looking directly at the DXY. And there have been days where it has been very clear to me, you look at those lines, and I've been starting posting charts that have, instead of 2 lines, the 10-year and the gold price, have 3 lines, the 10-year, the gold price, and the DXY. And there have been numerous days over the last couple of weeks where it's clearly gold responding to the DXY instead of the 10-year. So it's clear, but not proven. It's interesting because it shows a change of phase, if you will. It shows that these people who we love to despise, who set the price of gold based on these future contracts, it shows that they're rethinking their models, or at least suggests it to me. And that could portend interesting things to come, especially if we look outside the window as the weatherman and we see the reality is that inflation is running much higher than what the powers that be tell us. It could be that those traders we love to hate start changing their modeling. And that's interesting. And it gives us a potential predictor, a new predictor. And I don't like making grand predictions. But if it turns out that a lot of traders start relying more directly on the DXY instead of the 10-year as a day-to-day judge, you can look at, well, who is printing more? It gives you more variables. You can start looking at the dollar's strength in a different way. And it may result in a different view of prediction. And my own feeling is that the US is probably going to win the race to the bottom. It's probably going to debase its currency more. There are different monetary policies, and it looks to me like the US is doing more direct mailing of checks, more direct money printing. Back to your question about monetary inflation. So I don't know this, but I think that we may see gold prices respond more directly to monetary inflation. That's the good news takeaway from this. If I'm right, it's early days. It's only happened over the last couple of weeks. But if that takes off and it becomes the dominant relationship, then we could actually see a much closer relationship between money printing and gold prices, which I think most gold and silver bugs would love.
Okay, great. So Lobo, you appear to be a gold bug. For the benefit of millennials that are listening to my program, why buy gold and silver?
I want to say that even though I don't currently own any cryptos, I have gambled. I don't call it speculation. I have gambled on them before, and I made some money on Ethereum. I don't own any cryptos at the moment. I am not hostile to the idea. And you didn't specifically mention this, but that's sort of, I think, the immediate counterparty question here. Like, if it's not just why buy gold and silver, it's like, why would I buy that when I could buy XYZ crypto that can go up 100 times next week with the right tweet behind it? I want to specify that I'm not hostile to cryptos. As a libertarian, as a hardcore free marketeer, I would like to see governments entirely out of the business of money. I think money should be a free market phenomenon and would be better off if it was, instead of having the politicians interfere in that. So I see the cryptos as a market response to government mismanagement of money supply. I think that's fantastic. And so my view is really, may the best money win. And I don't subscribe to the Bitcoin maximalist theory that in the end, like the one ring of power, Bitcoin is going to combine them all and in the darkness bind them, or maybe in the light. But I do see potential uses for cryptos as they solidify. And I like cryptos with use cases. I can see the market going there. I doubt the market will choose one form of money. So this comes to answer your question, is that there can be different kinds of money. It doesn't have to be one kind of money. There are some cases and some uses in which a physical form of money is very useful. The lights go out. China pulls the plug on Bitcoin mining and suddenly the whole system gets unstable, or who knows what happens. You're offline for some reason and all your money is digital. What do? Well, it might not be a bad thing to have something of physical value you can hold in your hand that people can see, they can feel the weight. By the way, this is one thing I recommend to all young people who've never really looked at this or thought about this before. Go down to your local coin shop, and if they'll let you, hold an ounce of silver in your hand, or ideally hold an ounce of gold in your hand. Hold a 1 ounce gold bullion coin in your hand and feel the weight of it. It will change how you think about it. There is so much value packed in so little space, and you can feel it in your hand. Now that may sound emotional and illogical, but it's not. It matters because gold has unique chemical properties, including its density, which is very hard to fake. It can be done, but it's very hard to fake. And that's why it's been used as money for thousands of years. So the quick answer is diversify. Why would anybody want to hold this old boomer stuff that's historically of interest, but now it's a barbaric relic? Well, because it does have thousands of years of use. It's universally recognized all around the world. It does have value in and of itself. And it is consistent, convenient, divisible, right? All those qualities that Aristotle defined 2,000 plus years ago, they're all still true. So why would you not diversify? Why would you put all your eggs in one basket, which is inaccessible if the lights go out? So that would be one answer. The other answer, though, is actually, never mind the metals. Look at the stocks. If your goal is to make money, right, you shouldn't be religious about it. Like, oh, I only want to make money on Bitcoin, or I only want to make money on Dogecoin, or whatever. That's a very, blinders constrained way of thinking about making money. Why would you do that when there are other opportunities? And I can tell you that, it might be a once in a lifetime thing for Bitcoin to go from $1,000 to $60,000. It is several times a year thing for some mining stock that makes a great discovery to go up 10x, 20x. 10 baggers and 20 baggers don't happen all the time. Don't get me wrong. I'm not saying buy any of these stocks and they're going to go up 10 times. I'm saying that it happens every year that some of these stocks do that, or 20 times, or 50 times. I have seen 50 baggers in my career. I have never experienced a 100 bagger. But I've seen the data, and my friends, my mentors have experienced them. And by the way, people like to say, oh, Microsoft and Apple, those are 100 baggers. Well, yeah, but it took decades. And you had to not only be right in 1982 or whatever it was, you had to ride those suckers through these most incredible ups and downs and have the guts. I mean, before HODL became a thing, right? How many people would have HODLed Microsoft when it melted down, or when its entire business model seemed to go out the window, or Apple when it melted down, right? So those things take decades to get a 100 bagger. A gold stock or uranium stock, or some of these that make the right discovery in a raging bull market can deliver a 100 bagger in a year or two. And 10 baggers and 20 baggers, those happen, again, not all the time, but routinely enough that this is something that I think anybody who wants to make money, you're not talking safe wealth preservation here, gold. We're talking speculation for capital gains. If that's something you're interested in, you should be looking at gold and silver stocks.
All right, thanks for explaining that, Lobo. So Lobo, this brings me to my next question. Do you expect that the precious metals will go up in the second half of the year? What chance do they have of going higher than they did last August? Any price predictions in the next 6 months?
Yeah, I'm very reluctant to make specific predictions like that. My friend Doug Casey likes to make predictions, but not say when it's going to happen. So that's his sort of like escape hatch. Oh yeah, I was right. We're going into a depression. Yeah, well, he made the prediction 30 years ago. He's right. I love Doug. I'm not throwing him under the bus. I'm just saying that it makes for great headlines. If you could put a headline on this interview, Lobo Tiggre predicts $3,000 gold by September 30th, you'd get a lot more clicks. Great clickbait. But the chances are that I would be wrong, even if I was right later. I hate being wrong. But more than importantly, I don't want to encourage anybody to make an ill-advised decision thinking they know that something's going to happen because the great Lobo Tiggre said it was going to happen. Right? I don't want to do that. But I will answer your question. I think the fundamentals here argue for higher metals prices over the course of this year. I think this transitory narrative that the powers that be have is going to fall apart. I think people are going to see higher prices sticking around. I think wage inflation is happening and will happen, maybe not as much as people like, but it is happening. And that never goes into reverse. Once you give somebody a raise, it's really hard to take that raise away from them. You can only really fire them. You can't take a raise away from anybody. And they'll quit if you try in almost all cases. I think we're looking at higher inflation. I think that's bullish for gold on the fundamentals. I think even the traders realize this because higher inflation will mean for lower real rates. And depending on how much CPI outstrips nominal rates, it could be, much, broadening, much deeper, lower rates, which is very bullish for gold. I think it also can set expectations into play where people are so afraid of higher inflation yet further ahead that they start piling into gold regardless, just because of that expectation. We have often seen in the past data that gold prices correlate more with inflation expectations than they do with the actual inflation numbers themselves. Rather than give you a specific price target and a time frame, I will just say that I am bullish for higher prices over the course of the rest of the year. Potential for near-term headwinds, as I was saying before, with the base effects rolling off. But I think reality is very bullish. I think over the years ahead, my outlook ranges from bullish to wildly bullish. Because if inflation is stubbornly higher than they want, and the economy is still in recovery mode, what do? They keep saying, oh, we got the tools, we can fix this. Well, the tool is to raise rates. But if you can't raise rates because the economy is still in the tank, you have no tool. So there's the potential for this to spin out of control. It's not a prediction. I'm saying there's potential for this to spill out of control. If the powers that be lose control over this story, if inflation gets out of their grasp and people start saying, oh, it's going to be like the 1970s, not just thinking it might be, but like, holy cow, this looks like the 1970s, I think you see gold go much, much higher. And some of these wild and crazy predictions that people have made won't look so wild and crazy then. I'm going to say, I will go so far as to say, at the very least, before all is said and done, I do expect gold and silver to hit new nominal all-time highs and potentially new real all-time highs, which takes silver up in the 170 range and gold closer to the 3,000 range. Those sound like pie in the sky numbers to some people, but I do think we can hit those before all this is done. And if things do spin out of control, I have no upside limit on how high things could go. You could actually end up remonetizing or putting gold and silver back into circulation, which would, theoretically take the gold dollar exchange ratio almost infinite when people stop taking paper dollars. That's not a prediction. Just saying, it's a possibility out there. But a more reasonable thing, like as an investor, as a speculator, yes, I think gold and silver are heading higher. I think any near-term weakness we get is an opportunity to take advantage of.
All right, so this leads me to my next question. What allocation advice would you give us for investing in precious metals? How would you spread your portfolio between the physical metals, the ETFs, and the equities?
Well, it's not an allocation question, particularly for the metals themselves. And this is something that really Doug Casey hammered into me. I didn't need to be taught this, but he made it clear, and I want to give him credit. And that is that owning the bullion, owning the gold and silver, your stacks, that's not a speculation. That's a stack of silver. And if someday I need something of physical value in my hand that I can use to pay for something, I've got it right there. That's savings. That's for my mind, I haven't gotten around to putting this in my permanent midnight gardening storage facility. But that's what that's for. I don't consider bullion a speculation at all, or even an investment. That's when I have extra money that I can put away for long-term savings. That's what I do. I stack. The stocks are another matter. That is highly speculative. Now, as an investor, I might say, oh, well, the the major producers are a relatively safer investment. But the reality is that commodities prices are so volatile that even the biggest and the best mining companies in the world, the bad news is that they can give you a 50% haircut in a couple months if things go bad. The good news is that even those big so-called safe companies can double, triple, or more in a raging bull market. So I really don't think of any metals and mining companies as investments at all. I think they're all speculations. So there's no one size fits all. Where this comes down to is each of us needs to ask ourselves, what kind of investor or speculator am I? What's my risk appetite? If I am more risk averse, then yes, of course, I like the bigger, profitable producers. They still offer excellent leverage to the underlying metals. If the metals go up 1, 2, 3%, the stocks will go up, 4, 10, 15%. And that's good money as an investor or speculator. If I'm really looking to make money, though, if I want to swing for the bleachers, I want those 10 baggers I was talking about earlier, then you have to go farther down on the food chain and look at the juniors, look at the exploration companies. But they are risky. You have to understand when you're doing that it's not really investing. I think it's better than gambling. You're not just, closing your eyes and throwing darts at the board or putting money on 23 red. You're looking at companies that have a process. There is some science to the geology of exploration and discovery. You look at the process, you look at what they have, you look at what they're doing, you look at the results they're getting. You do everything you possibly can to weed out, the chaff and the wheat and get the ones that are actually delivering. And there's a lot of money to be made there. So what's the correct allocation? It does, if I'm a retiree on a fixed income, maybe it's a lot of bullion and a few major miners. If I'm a 20-something with no children, living at home and no real expenses, just beer money for the weekend or something, maybe it's no bullion, it's no big producers, it's all juniors, and just swing for those bleachers, man. Bring us a home run or two in here. I can't tell you what the right way to do it. But you need to know yourself. You need to know what your goals are, and you need to be honest. Can I take it if this junior goes down 30 or 40% in a day with nothing wrong with the company, or is that going to make me panic and sell? Sorry, it's kind of a psychological answer, but that's the honest truth. It really depends on who you are, what kind of investor or speculator you are, and you have to play to your strengths. And if you know that you're, kind of chicken shit when it comes to bad news. Sorry, that's a technical description. You're going to make emotional decisions and you're going to take unnecessary losses. It's probably better to stick with the larger companies if you just can't take that kind of heat, because the larger companies are going to give you plenty of heat as is.
This leads me to my next question. Could you share with us your philosophy of investing in mining companies? What proportion of your gold and silver miners are large producers, mid-tier producers, developers, and juniors?
A really great speculation, something that I just feel both has very high odds of delivering and very high gains if it does deliver. I'm not looking for 10, 20 double-digit gains. I'm looking for triple-digit gains or better. If I can see something that I feel really good about, has really good odds of delivering that kind of gain, then I'm very interested in buying regardless of what my portfolio allocation is. Now, if that happened to put me 100% in junior uranium stocks, yeah, I'd have to do something about that. That's too much. That's never actually happened. What tends to happen is I buy something because I think it meets those criteria. And that kind of speculation is rare enough that I want to jump on it when I find it. And then I might find, I really got a little more uranium than I want now, or not enough uranium, or it's all gold here. I need more silver here. And I'll try harder to find one of those great speculations in the area that I want to add. But if I find a really just fantastic overlooked gem in uranium, and I'm saying, but I've already got X percentage allocation to uranium, I'm not going to walk away from that, right? If it's a great speculation, I'm not going to walk away from that. I'd probably buy it and then look to adjust later. Or I might say, okay, if I have too much uranium, then which stock is this one better than? That I'll sell that one so I can buy this one. I might do something like that. To answer your question, my own approach is sort of a barbell strategy right now. And that is that I'm bullish enough that I really want to have exposure to particularly gold and silver and uranium. And it's really hard right now, especially in the silver space, to find companies that don't have serious problems, not just warts, but like big gaping holes under the waterline. So I've actually bought more larger companies than I normally would. And what that does is it makes for a kind of barbell strategy, if you know Nassim Taleb's barbell thesis. And that is, instead of going down the middle of the road and thinking that I'm being safe and balancing my risk by going with the middle of the road companies, I have a larger allocation to some of the larger, relatively safer companies that give me, some more solid leverage to the metals that I like. And then I have another bigger allocation to the juniors that are more the swing for the bleachers, big gains. And that the bigger companies mitigate some of the risk in the smaller companies. And at least according to Taleb, I'll tell you how I do in a year or two. At least according to Taleb, this is actually safer and produces higher overall gains than shooting for the middle. And what is the middle in mining? It's the mid tiers. And in my mind, I know that my friend Rick Rule likes some of these mid tiers that he sees as takeover candidates. Don't disagree with that. Most mid tiers are not great takeover candidates. They're not a single asset miner that's just a crown jewel waiting to be plucked. Most of them are amalgamations of smaller companies, and a lot of them, it looks like, oh, great, we produce 2 million ounces a year. But, it's a little bit from here, it's a little bit from there. This one's more expensive. That one's really doing great. This one, not so much. A lot of them are very problematic. So you have, with my mind, you have a lot of the downside and risks in the mid tiers that you get with the juniors, but you don't have the stability of the majors. So it's kind of like the worst of both worlds instead of the best of both worlds. So you have to be very picky about the mid tiers, in my view. Though I am sympathetic to the takeover candidate thing, but not everybody's good at as good as Rick at predicting which ones those will be. So you can call that a philosophy or my adaptation of Nassim Taleb's barbell strategy. But I should also say that it's kind of an artificial one. I'm still in the phase of my life where I'm mostly looking for capital gains. I'm not trying to protect wealth, I'm trying to generate it. So normally I would not own this many larger companies as I do right now. I'm simply in those larger companies while I'm looking for those truly great speculations in the smaller space that I favor.
You also have to be very patient as well, too, with these companies in the mining space.
The ideal speculator, in a truly ideal world, the ideal speculator is like the Baron von Rothschild saying, right? Buy when there's blood in the streets. If you think of that literally, you're talking about once in a generation buying opportunities. How many speculators or investors are really that patient? You're going to wait once in a generation, right? Buy during the revolution and then live off that for the next generation. Almost nobody does that. And certainly as a newsletter writer, I can't have that kind of time perspective. This is one of the differences between me and Rick, by the way. Rick is a broker. He has clients that trust him, and they're very long term, right? He can come to his clientele with a 4, 5, 7-year investment thesis, and they'll stick with him. If I try to sell newsletters saying, hey, buy this stuff, buy my stocks, and maybe 5, 7 years down the road, we'll all be okay, I'm not going to sell any newsletters. So I'm not saying, therefore, I'm willing to compromise and go after crappy recommendations just to sell newsletters. I know what I'm saying. I'm saying that the relevant time frame for my investments and what I strive for is actually within the next year or two. Beyond that, and it's just beyond the time frame that most investors or speculators are willing to be patient with. So personally, I could hold a stock for a long time if there's nothing wrong with the company. But as a publisher of financial newsletters, I need to be aware of what my customers want. And so it is part of my selection criteria. I need to see deliverables within a year or two. And if the company doesn't deliver, if they fail, then I need to prune that from the portfolio. I can't just hold them forever and have my portfolio just get bigger and bigger and bigger and bigger. This is a really important point. I think patience is fantastic. It's great for those who have it. Few people do. And it's not just patience, it's patience coupled with the ability to weather the ups and downs. Here's a thought. I don't know how much of your audience is as young as you appear to be, but here's a thought. If gold bugs had the guts to hodl the way crypto buyers have, like if gold bugs had come up with the term hodl instead of Bitcoin fans, I think the whole resource sector space would be very different. People investing in these junior mining stocks, they panic and they sell when there's nothing wrong with the company. And crypto people don't do that. They either hodl or they buy more. So there's a little bit of tough love for gold bugs from me here, but I think maybe gold bugs could learn a thing or two from those millennials they like to look down on. Look at the way they hodl in something they believe in. If you believe gold is money, if you believe this stuff has real value, if you agree with me that its prices are going up, then don't be so quick to get disgusted and sell something just because the price doesn't go the way you want it to.
So Lobo, I know you follow the uranium space as well. Are we at that cusp of the next uranium bull market? What makes you think so?
One way to frame this is that uranium really bottomed in late 2015, early 2016. It has been in an upward channel. Here's your technical analysis. Actually, uranium has been in a fairly regular upward channel for 5 years. That's a pretty solid trend. And what happens though is that within that channel, it goes way ahead. It goes above the top bound of the channel, and then it comes back. And so it's like this 2 steps forward, 1 step back thing. And every time one of these 1 step back happens, people panic, people sell, they don't hodl, right? People get all angry. Oh no, uranium's terrible. They give up on uranium. But the fact remains that we keep in this channel. We keep seeing a higher series of highs and higher series of higher lows, which my technical friends, they tell me it's the higher lows are the bottom channel bound is really important, they say. And that hasn't been violated yet in 5 years. I think that, so it's not just, is uranium going to take off tomorrow? It's uranium has already embarked in this long multi-year upward trend in the fundamental context of you can't mine this stuff profitably at current prices still. Now, that big picture having been said, uranium's having a good year. I think, in fact, year to date, uranium is currently up more than Bitcoin is on a percentage gain basis. Last time I looked. Now, doesn't mean a whole lot. Bitcoin corrected, uranium's up at the moment, but interesting factoid. What makes it particularly interesting now, though, is that the data to me suggests that the things that have been really holding uranium back, the things that have made it take those giant steps back after the 2 steps forward, those seem to be changing. There was excess secondary supply in the market. How can uranium prices be less than what it costs to mine it? Well, because you don't have to mine it. If you're a nuclear power utility and you can buy extra uranium from Japan where they shut down all these reactors, you don't need to go to a miner. The data seems to say to me that excess secondary supply is drying up or has dried up. And the corrections that we've seen recently have been more modest. And as you and I speak, actually, over the last couple of weeks, uranium has been ticking up significantly. And so I'm not promising this, it's not a prediction, but it may be that we're at one of those points where uranium wants to make its next 2 step forward. And if it does, the stocks should respond with gusto.
So moving into a different direction, what advice or recommendations would you have for my listeners to learn more about the precious metals and base metals market?
Well, the first thing is do that, right? Learn more. If you want to make money, it's not just about stacking gold coins in the basement or something like that. You want to look at mining. You want to look at commodities in general. And I think the monetary metals are particularly interesting right now in the commodity space because of the global phenomenon of easy money, monetary and fiscal policy. But it's not just that. Copper's up, nickel's up, lithium's up. Lots of things are going higher. If you do that research, you'll find that the reasons for this look sustainable for many of these. The electrification story is very strong. It's a multi-decade trend. I'm very bullish on copper, by the way. So yeah, do that research, start looking. And there is a lot of free information out there. I have some free information out there. Yes, I am trying to sell you something. I hope that people who sign up for my free services are impressed enough to sign up for my paid service. Never forget that if you're getting free research, you are the product. That having been said, I don't tout stocks. I'm not paid by any companies to promote their stock. Even the companies that I interview, they don't pay me. In fact, I require them to sign a media release before I interview them. That way I can ask them the hard questions and not just softball ones. And if they don't like it, I publish the interview anyway. So number one takeaway is actually, yes, do this, but be skeptical. A cardinal primary attribute of successful speculators is skepticism. Never take any company at their word. I'm not saying they're all liars. I'm saying they all have a motivation to put the best possible explanation on it. If if I look at what a company says, I want to look at what they say about what they're doing. If a company is a silver company and the CEO gives you his reasons why silver is going higher, I don't listen to that at all. Of course he's going to say that. He's a silver company CEO. And if he's a uranium guy and he's saying why uranium's going higher, I don't listen to that either. There's so much noise out there. You really have to have a good noise to signal filter. And the number one thing to do is just be skeptical. Even if you're not an expert, it's not that hard to detect bullshit. That's the Neil Stephenson technical definition, right? When claims are impossible or exaggerated, you're not wrong to be suspicious of that. I don't have a single source that I can say, here's the authoritative way to sort all this out. I can say that I do my best to help with that. The free material that I put out is educational. It's intended to help everybody learn about this business. My paid stuff is, okay, so tell me about the stocks, right? So that I don't give away. But in terms of how-to kind of stuff, there's a lot of free information on my website. I'm not sure about other ones. I mentioned Lynn Alden before. You mentioned in your intro, Brent Cook. I think his website, his research is top-notch. And he also is not afraid to call a spade a spade. And there's other people out there. Just have your bullshit detectors on all the time. I don't know that without a lengthy discussion I can say that's more useful than that.
Okay, great. So Lobo, what commodities do you think will perform best in 2021?
Gold and silver. I do think uranium is amongst them. It's already doing there. I am still very bullish on copper. The electrification story has a lot of different things in it. Lithium may continue to do well, but it's not rare. And it has gone up sharply. So I'm concerned about lithium. Nickel is also problematic. There were supply constraints in the nickel market that are coming loose. So I'm a little bit less bullish on nickel now than I was before. I'm not saying they're going to tank. All of these things that go into the batteries and by the way, silver is also an energy metal. It's not just a monetary metal. Those solar panels, even the Tesla solar panels, they all have silver in them. So if you're bullish on, decarbonizing the world, then you have to be bullish on silver. So I'm broadly bullish on all commodities. I'm broadly bullish on monetary metals and anything that goes into the electrification story. I'm very bullish specifically on uranium, and I like copper, though it has gone up a lot, right? We've already seen new nominal all-time highs, so it's very difficult for me to say, yeah, run out and buy copper. That's why we haven't really gotten to it till the end of the interview here. But I do think over the next decades, copper goes higher. And therefore, if we do see copper pullback from its nominal all-time highs, I see that as a buying opportunity. So short version is gold and silver with more volatility, but also more upside than gold, uranium, and then maybe copper next.
All right. So Lobo, who is a future guest that you would like to see on this show?
Some of the ones we've mentioned already. I think if you haven't had Lynn yet on, I think she's fantastic. I think Brent does a great job. If you want to talk more technically about the rocks and what does your audience, there's so much geology. Not everybody's going to run out and take a degree in geology, but what are the essentials? What do you really need to understand press releases from mining companies and exploration companies and so on? Brent can be a great help for that. And you don't need me to tell you this, but actually I think it's interesting that Rick has now gotten to a point in his life, he's semi-retired, he's really in that give back mode, and not just financial advice, but life advice. And he's given some really, I think, terrific interviews recently that I've known the guy for almost 20 years, and I'm still learning stuff from these new interviews. So if you haven't spoken to him recently, I would get him on. I think he'd probably be happy to do that because he is in that give back mode.
Okay, great. So Lobo, where can my listeners go to see your work and connect with you online?
Sure. Well, the website is independentspeculator.com. Again, there is a free service. There's a weekly digest we put out. In fact, that's the next thing I need to do when I get off this call with you is wrap up tomorrow's edition. Obviously, as said before, I do have an interest in this, but I will say, and it's a true thing, if you sign up for that, I will not spam you with a daily flood of hyped up advertisements. That's not how I do business. It's a weekly digest. If you sign up for that, you get one email per week. And I hope that you will find my educational services valuable enough to consider doing business with me in the future. But if not, just being part of my audience, that helps me to, have that audience as a newsletter writer. So you're still valuable to me. And I try to put as much value as I can into that free service. Again, independentspeculator.com is the URL. There's an about page and other explanations. There's a contact form if you have a question. So far, at least, I've actually been able to keep up with answering questions myself.
Okay, perfect. I will make sure to add that to the podcast notes. And once again, Lobo, I just want to really take the time to thank you for your mentorship. Thank you for your leadership. And most importantly, thank you for your time right now. It's been a pleasure to have you on the show.
Well, thank you. I'm not at that phase that Rick is at, but I like teaching and I like helping. I like that to be a win-win relationship, of course. But if I can help people to achieve more in their lives, living your greatness, I think that's a great idea. I encourage that.
This podcast is for informational purposes only and is not to be considered personal, legal, or investment advice or a recommendation to buy or sell securities or any other product. It is based on opinions, current events, press releases, and interviews, but is not infallible. It may contain errors, and Living Your Greatness offers no inferred or explicit warranty as to the accuracy of the information presented. If personal advice is needed, consult a qualified legal, tax, or investment professional. Do not base any investment decision on the information contained on Living Your Greatness or our videos. Thank you for listening to the Living Your Greatness podcast. If this show has added value, please subscribe, leave a rating, and make a review.